And continuing the conversation here, for more on the employment situation, we bring in Lindsey Piegza, who is Stifel's chief economist. Lindsey, great to have you here with us today. Perhaps we begin with the employment data. And does this week's employment data give added strength to the calculus that the Fed has telegraphed thus far?
Well, it certainly was a welcome data point to support the Fed's thesis that the economy is in a position that it's strong enough now that we can begin to remove some of these accommodative measures that were initiated at the onset of the crisis. The Fed is poised to conclude its bond buying program at the next month's meeting and also initiate liftoff, meaning the first rate increase. So with this in their back pocket, this, again, certainly justifies or bolsters the argument that the Fed is on the right path to slowly remove accommodative policy.
Lindsey, looking at the estimates heading into this morning's jobs report, many economists were looking for a negative number out on payrolls today, and clearly we didn't get that. What do you think economists were missing about the labor market and the underlying strength there heading into this report?
It is a good question. The payroll number was significantly stronger than expected, although when we look at the household survey, this was markedly weaker than that top line payroll number. And in fact, when we look at this, coupled with the fact that there are slowly more Americans moving into the labor market, with millions still sidelined, we actually saw the unemployment tick higher to 4%. So there is a little bit of an unclear message in the labor market at this point. Yes, we're still putting Americans back to work, but it's unclear if this is a sustainable upward trend or if we're still seeing a volatility in the aftermath of that global pandemic.
And next week, of course, going to be big with some of the economic data that we're standing by for CPI and PPI. What notably would you be watching for there, and how the Fed may continue to digest inflationary data that they're going to be receiving, even if they have telegraphed what the move may be thus far?
Well, it's interesting because headline inflation, the Fed is very much convinced that we're going to begin to see relief in the form of a second derivative decline, or meaning a slower pace of still positive price pressure. So if, in fact, we do start to see that relief, a slower gains on a monthly basis, beginning to peak out on the headline number, at least on an annual basis, this is going to alleviate that sense of immediacy or sense of urgency for the Federal Reserve to act aggressively. Now, we still expect the Fed to act. Slower growth and a more benign inflation number doesn't negate the Fed's need to move off of zero levels. But if we do start to see inflation subside, even slightly, this is going to remove a lot of that pressure on the Fed to raise towards some of the more hawkish estimates of 4, 5, even 6 rate hikes within the next 12-month period.
Given where we are right now with the data, do you think we get a 50 basis point hike out from the Fed in March?
I don't think we do. I think the Fed is very committed to removing policy accommodation, but I think they're also committed to doing it at a very gradual pace, letting the economy, letting the market have time to absorb these movements in monetary policy and making sure that they're not going to pull the rug out from under the recovery. Remember, it's a very delicate balance. The Fed does want to control inflation first and foremost, but they also recognize that the market is still very much dependent on the monetary policy punch bowl. So they don't want to do too much too fast, shock the market, and then undermine their longer term plan to a higher platform of the federal funds rate.
We heard from President Biden and, of course, on the jobs data, looking through that and trying to, of course, look at the broader economic recovery and signal that we're an economy that can continue to move forward despite what COVID has thrown at us in the past and what may continue to come in the form of variants in the future. And so to what extent do you believe that the economy is beginning to show some signs of insulation, even if there are some spots that are still weak areas?
Oh, I think we're very much taking large steps in the right direction, and we've seen already the initial green sprouts, if you will, of a more organic market as we did begin to see fiscal stimulus wane in the second half of last year. Growth returned back down to an increasingly more organic platform. Now, as we turn the corner and look out to 2022, assuming there's no additional stimulus, no additional funds in terms of COVID relief, we can start to see the market return back to a more organic level. Now, this is likely to be significantly less than what we saw at the start of last year, but I do think that in a range of 2 to 3% GDP, this is much more sustainable going forward. And if you recall, much more in line with the pre-pandemic level of activity for the domestic economy.
Average hourly earnings were up 5.7% year on year in January, according to this morning's jobs report. I'm wondering, how do you see consumer spending evolving going forward, considering where wages have been heading, but also the inflation on the consumer prices side that we've been seeing recently as well?
Absolutely. So businesses at this point remain desperate for workers. There are over 10 million job vacancies in the marketplace at this time. So it's not a lack of opportunity. It's not a lack of job opportunities, but it's a lack of able and willing bodies coming into the labor market. So as a result, businesses continue to bid up what they're willing to pay workers to come into the labor market. And this is in the form of wages, benefits, better healthcare programs, free childcare, anything to try to offer that incentive. But as we saw this morning with wages up 5.7%, this is absolutely a stellar increase. But when we put it against 6-7% inflation, all of a sudden that increase is significantly less impressive. Then you couple that with the fact that a good portion of the savings that was accumulated over the past year plus during the pandemic is beginning to significantly dwindle. You layer on the fact that a lot of forbearance opportunities are now being called in, and you look at the spending patterns of consumers going from pandemic back to pre-pandemic levels. Well, right now, I would say that the consumer remains on solid footing, but certainly downside risks to this consumer remain.
Lindsey Piegza, who is the Stifel chief economist, joining us here today. Lindsey, we appreciate the time and the insights. Have a great weekend, and thanks so much for joining us.